Hello, welcome back to another episode of How To with Ziad. This is actually our 7th episode now, and this will play as a part 2 of our episode last week where we talked about how to pay less on taxes while investing. So let's add on Ziad. Our lives before. How it works is essentially I bring up a topic or ask Ziad a question, and then he answers it. So hi Ziad.
Hi Mia, how's it going?
It's going good. It's Thursday, almost Friday.
Almost Friday, yep.
Right through the week, busy week. How are you doing?
I'm doing well, I'm doing well. It's been a busy week for me as well, but excited to continue on this series. Yeah.
Right. So let's talk a little bit more about our topic today, which is a continuation from last week and on how to save on taxes while investing.
Yeah, exactly what that is. You know, last week we just kind of covered how when you invest, it's not like you still have to account for paying taxes on the growth in your investments. And so what we want to do is just talk over certain investments, certain strategies, and certain kinds of accounts that you can use to take advantage of minimizing your tax liability while still getting your money growing for you. And so last week we talked over different strategies such as tax loss harvesting, such as rebalancing. We talked over some common retirement accounts and educational savings accounts. And now I think this week we just want to talk over some of the lesser common accounts and strategies that we can take advantage of to make sure that we're minimizing our tax liability.
Exactly. And with that being said, everything that we talk about is not made to be a recommendation. If you have any questions about your specific situation, definitely go talk to your financial advisor and reach out to us if you don't have a financial advisor and you have some questions.
Yeah. And to add on top of that, if you do have any specified tax advice, seek a tax advisor, seek a CPA or an accountant. We do help as financial advisors with the big picture of things, making sure you're saving as much money on taxes as possible with your investments. But when it comes down to the dollars and cents of different accounting situations, talk to a CPA as well. It's one of the big reasons why, again, like I touched on last episode, outside of advisors, CPAs are one of the most trusted financial professionals you can talk to.
Right. Yeah. And with that, let's get started. So I thought it'd be good to start us out with a definition that I think we'll be using this term a lot, and that is cost basis. So cost basis is the original value or purchase price that an investor purchases an investment at and will later be used for tax purposes.
Yeah. Yeah, exactly. And so whenever you think about selling an investment at a gain or a loss, what the IRS is looking at is what is your cost basis. And so it is very synonymous with purchase price. There are certain scenarios where your cost basis will change, even though you didn't purchase or sell an investment at a certain time. And so that's why they use cost basis rather than actually using the term purchase price. But just something to keep in mind, you think about if you bought an investment at $5, sold it at 10, that $5 purchase price is your cost basis. The $5 profit from that is your gains that you're going to be due for taxes on.
Definitely. So if we use that term, that's what it means. But also if you have questions while we're talking, feel free to ask them, put them in the comment section. We'll try to answer them right away.
Yeah.
I'll be looking out for them. So last week we were asked about 1031 exchanges. And 1031 exchanges are swaps or properties held for business and investment purchases. This allows capital gains to be deferred. So do you want to touch a little bit more on that?
Yeah, most definitely. And so 1031 exchanges, they are for real estate investments. So when you think about if you bought, say, a home, right, and it's meant to be as an investment, most times when you're purchasing property, you're purchasing it for a long period of time. Those values appreciate a lot. They gain in value a lot. And so when you want to move elsewhere, change your investments or anything along the lines of that, you have the potential of being due for a large tax bill when you do sell your property. And so what a 1031 exchange allows you to do is sell your property and purchase something that is similar to it. So the big thing here is that it needs to be a like-kind transaction. And as long as you do that, you keep the cost basis that you had from your original home and just transfer that over into your next property. It's you don't have to pay taxes on any growth. It's only once you sell that real estate property for, say, cash instead, that's when you're due for the taxes. And so it helps just avoid any kind of tax bill that you don't want to be paying right now.
Yes. And
Hmm.
then with the Tax Cuts and Jobs Act of 2017, I know 1031 exchanges, um, it included franchise licenses,
Hmm.
aircrafts, and equipment, but I don't think it includes that anymore.
No, not anymore. Now it's just solely real estate.
Right.
Hmm.
Well, another investment that's very attractive for someone looking to save on taxes are municipal bonds, or
Hmm.
more commonly referred to as muni bonds.
Yeah.
They're issues from the state or local political entities.
Hmm. Yeah. They're issued by, say the government of California wants to build a highway. They're going to issue municipal bonds rather than, say, a national bond for that. And so the beauty of these municipal bonds is that they any interest that you gain on it or any gain that you have on these bonds is going to be federally tax free. And then the big thing to note is that if you purchase a bond from the state that you reside in, it's also going to be tax free, state tax free as well. And so, say you live in California, if you purchase a California municipal bond, any interest or gain that you get on this investment is going to be entirely tax free, which is a great tool for our clients and individuals and investors who are in those higher tax brackets.
Absolutely. And
Mhm.
so if you have a 5% return on an investment and you're taxed on half of that, you're only really getting 2.5%. So then
Yeah.
with the municipal bond, if it beats that rate, then you're better off.
Yeah, exactly. You basically want to find that effective tax rate or effective interest rate after taxes. And so that's a conversation that as advisors we have with our clients all the time, making sure that we're really maximizing the amount of interest that we're getting in those kind of investments.
Yes, always the goal.
Hmm.
Um, Other tax efficient accounts that we haven't talked about yet are health savings accounts, and
Hmm.
they're used to pay for or reimburse for certain medical expenses that are incurred. They can help people with high deductible health insurance plans cover medical expenses, as I said before, rather than paying out of pocket.
Yeah.
And so let's talk about how they can minimize tax burdens and what tax incentives are attractive about HSAs.
Yeah, and the big thing to highlight here with an HSA is that you do need to have a high deductible plan, which means that most of your expenses you are paying out of pocket rather than your insurance paying that for you. But if that is the case, this is an amazing savings tool for you. Any money that you contribute, you will receive a tax deduction for, and as long as you use that for health or qualified medical expenses, that's going to be growing. It's getting invested and growing, and will be tax free. One of the additional added benefits behind an HSA as well is that if you keep this money until you're 65 years old, you won't have to pay any kind of tax penalties or anything on that as well. It's used as kind of this alternative retirement vehicle um, for certain people who are maxing out their IRAs or their 401ks. They can contribute to an HSA as well.
Right. And then
Hmm.
similar to the educational accounts, which we talked about last week,
Hmm.
for the non-qualified expenses of HSAs, if you withdraw, then you are taxed on the amount that you withdrawed and 20% penalty rather than the 10% with the education funds.
Yeah, exactly. And so there is a huge tax penalty if you're using this for anything that isn't those medical expenses, or if you don't wait until you're 65 years old. It really is incentivized for you to use this for medical expenses more, that kind of alternative retirement savings vehicle. One of the other things that I do want to highlight with an HSA is the fact that unlike there's a second popular health savings account called a FSA, a flexible spending account. Unlike that flexible spending account where if you don't spend that money by the end of the year, it's all gone, this money rolls over year by year. And so say you have an outstanding balance of $500 in your HSA, that $500 is going to stay invested, stay growing, and will continue to remain in that account until you use it.
Yes, very important.
Hmm.
And we have a question here in the comments from Alan.
Hmm.
And the question is about 1031s. So it's selling real estate to buy other real estate, or is there something else that qualifies that isn't just real estate to real estate to blank per se?
Yeah, so Alan, if you weren't in our if you were tuning in a little late, we actually did touch on this a little bit earlier in this episode. There used to be stipulations where you could purchase, say, aircrafts or equipment, some things like that. But with the recent Tax Cuts and Jobs Act that came in 2017, 2018, now it's only real estate to real estate. And not only that, it has to be like kind real estate property. So if it's a single family home that you're selling, you have to buy a single family home. You can't just buy commercial real estate instead. And so.
Perfect. Thank you for clarifying that. And I think right now it'd be great if we just open up the comment section. If you have any questions at this time, ask them. And I have a question that was sent ahead of time, so I'm going to read that. We have grandparents that want to give a gift to a grandchild, and that money will be used for more than just educational expenses. It could be for the child's first car.
Yeah.
So what are the tax implications for the minor, and what's the best account to use?
Yeah, so if you are contributing, if you want to contribute funds towards, say, your child, to have when they become an adult, while they're still a minor, one of the best accounts out there is what's called a UTMA. Basically, it functions similar to a regular investment account, but the main difference is that this money is being contributed is transferring ownership towards your child. And so it's under the minor Social Security. Once you contribute your money into the UTMA, it's theirs to keep. But that money is growing, and any realized growth or any earned income or unearned income in that account up to $1,100 is going to be entirely tax-free. From that $1,100, if you add an additional $1,100 on top of that, that next $1,100 is going to be taxed at your child's tax rate, which normally is 0% because they're not working. And then above that, then it's just at the guardian's tax rate instead, so say the grandparent or the parent. And so there are slight tax benefits. It's not the most amazing of tax vehicles, but again, if you can save any money on taxes, you might as well. The big conversation that we have with our clients there with the UTMA is just that if you are contributing to this account, you have to understand that your child can use this for whatever they'd like once they turn 18. You can't take that money back. And so being able to see that control is an important thing, or is an important conversation to have, and something that parents need to be aware of.
Yes. And you definitely should look at all your options. I mean, it sounds like that's the best for this scenario, but contact your financial advisor to really figure out what's best for you. And I know that these topics are complicated, especially when it comes to tax. Tax is complicated. So I hope that we're able to explain it in a more simple way. And, the terminology is confusing. Ask us any questions that you have. Yeah. Also, give us recommendations of what you want us to continue talking about for next week's episode. That will be happening Thursday at 1 p.m. again. And, another topic that we could have talked about is donor advised accounts, but maybe that's a topic for a high net worth savings on tax episode down the line.
Yeah. Most definitely. I think we will touch on some more complex tax saving vehicles, tax saving accounts and strategies, definitely geared towards the more high net worth client as well. If you do have any questions, please reach out to us. We are here to help you and, with your financial situation, no matter how complex or how simple it may be. We want to sit down with you, take a good look at your financial situation and goals, and create a comprehensive financial plan for you. And so if you do have any questions, reach out to me at Ziad on Instagram, find me on LinkedIn, or Ziad at GerberKawasaki.com, or just give us a call at our office, 310-441-9393.
Hey Ziad, before we go, I see we have a really important question. Which one of the teddy bears behind you is your favorite?
Mine. So I would probably say the unicorn would be my favorite. I'm a big fan of those fairy tale creatures. So
Good choice. I agree with that.
Yeah.
All right. Well, if you missed, the beginning of this and you're just coming on at the end, we always post them on YouTube afterwards, and it'll be on our IGTV. It's a little bit of tongue twister. IGTV.
Oh yeah. Thanks, Mia. Really appreciate it.
Of course. So we'll be back next week. See you.
All right. Bye.
Bye.